Mark your calendar for Wednesday of next week. That is September 18th, specifically at 11 a.m. California time. That is when we are going to get a new summary of economic projections. And boy, oh boy, the Fed might actually be interested in pre-bailing out markets here, leading markets to pump so that they can avoid a recession. Think about the 4D chess move here. Kevin's been saying for a long time, well, since like mid-July, valuations are a little toppy and we're one market correction away from mass layoffs. We did in the course member live stream this morning. We're looking at Cheesecake that can basically not even afford its bills this year. You've got, in other words, too much debt compared to the assets they actually have. They'll have to issue debt or new shares. You look at Red Robin losing money. They're probably going to go bankrupt under the weight of how many expenses they have. These are normal, everyday restaurants. You'd think that they're profitable. They're not. Then you're like, Oracle's doing well. And then you look at Oracle's balance sheet and they've got $100 billion of debt. They financed all their NVIDIA purchases on debt. Like a reckoning could be very, very, very close. And the Fed knows that. And ironically, the Fed might try to prevent that. Or I suppose unironically, the Fed might try to prevent that. And how could they do that? Well, with messaging next week. And I think the message is going to be really loud and really, really clear. And I think it might be worth thinking about betting on if you're a speculator, or thinking about, this is interesting. Is it possible that if this happens, markets might try to turn bullish so the Fed can avoid a recession? Let's think about it by looking at the last summary of economic projections, and what we're going to look for is messaging. The first and most clear messaging that we get from the summary of economic projections that I'm throwing up on screen now is that at 6 p.m. today, we have an expiring flash sale on those programs on building your wealth, the Zero to Millionaire real estate investing. You want to see the trade I just added to? It's now definitely in the multi-million-dollar range in terms of a trade. Make sure you're part of the Stocks and Psychology of Money group so you can see kind of the longer-term investments I'm making in addition to shorter-term trades or otherwise. Take a look at those. And remember, that expires at 6 o'clock California time today. That's 9 o'clock Eastern, so remember that. Email us at staff@meetkevin.com if you have questions. But anyway, so let's go to this. So there are a few things that the Fed can do here. And the first thing that I like to note is what the last summary of economic projections were, and then what markets are pricing in versus what my expectation is, and then what the Fed might do. So look at this. The black numbers here are the Fed's last projection. So they actually think in 2025 that GDP is going to be 2%. Well, markets actually think that GDP is going to be 1.7%, which means the Fed might revise down GDP for 2025. And I agree with markets. I think the Fed's going to go to 1.5 on GDP for next year as a way to justify why they're starting to be a little bit more dovish. I personally don't think that the Federal Reserve is highly concerned about inflation anymore. The numbers we had for PPI and CPI over the last 2 days have shown us that the leftover inflation on a month-over-month basis was just a little uptick in air travel and lodging. Both PPI and CPI showed the lodging uptick, but the last 2 months it was in the hole. So that's super volatile. I think they'll look past that. Owner's equivalent rents, we already know with leading market data that rents are falling. So I don't think the Fed is terribly worried about inflation. And as a result, I think they're more likely to signal a weak 2025 as a justification for why they want to start accelerating some of these cuts. And so that's why I think they'll show us a weaker GDP next week. By showing us a weaker GDP next week, you might see markets get a little nervous about recession, but the Fed might offset that by coming in with a Fed funds projection similar to what they had in March. Now, this summary of economic projections is from a few months later in June. And here we have the last Fed projection of 4.1 for the Fed funds rate, which for 2025, and only pricing in about one cut for 2024. Now I think they're going to go back to what they had in their March projection, which is 3 cuts this year and then getting us just under 4% for next year. So another, basically total of 6 to 7 cuts. This is a way that the Federal Reserve might be able to signal, hey, look, we recognize things are weakening. We recognize GDP is weakening. We recognize that, yes, the unemployment rate, which markets think is going to go up to 4.3%, I think they'll show 4.5 in 2025. I think the Fed's going to be able to message and say, hey, look, don't worry. We acknowledge that the unemployment rate is ticking up a little bit. We acknowledge that GDP is slowing a little bit. And as a result, we're going to go ahead and fight that ahead by coming in with lower expected rates for next year. In other words, we're going to price in some more cuts. Now, if they come in and they really want to be dovish and they really want to bail out markets, and I'll tell you why they might want to do that, then they'll come in lower than 4.6 here. Like if they come in at 4.5 or 4.4 for 2024, that means they're including a 50 basis point cut. Not necessarily in September, but potentially in the November or December meeting. Now, what does that potentially mean? Well, that means the Federal Reserve is trying to get ahead of a recession happening. It means the Fed realizes, okay, we're not maybe in a recession now. I know a lot of people do think we're in a recession now, but maybe we're not in a recession now. But we might be if we get one market correction. And so how do you prevent a larger sustained market correction from creating layoffs at companies like Cheesecake or companies like Red Robin? How do you prevent that? Well, one way you prevent it is by signaling your willingness to have more cuts, not necessarily doing the cuts, right? Go with the 25 BP cut. Don't signal more and then just talk about how in the future you're open to doing more cuts, which you could always revise. They're just projections, right? But you're signaling to markets, hey, rally, rally, rally. And when markets rally, 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 guess what ends up happening? Well, people end up not losing their jobs because other people keep spending money. The consumers keep spending money because of the wealth effect of the stock market and the housing market not crashing, and you're in a recession. The wealth effect hurts everything. So the Fed kind of wants to prevent this correction. And if you prevent this correction from happening, especially before the election, by being dovish, and as the buyback window period ceases before Q3 earnings come out in October, then the Fed kind of propping up markets in this normally volatile time could be the perfect way to avoid a recession, which the Federal Reserve might still be able to do. See, I've been concerned that if they go with a 25 BP cut, that they're just delaying the inevitable, that they're behind the curve, and that, they're going to cause a recession. Well, if they avoid that stock market-induced recession by having a sell-off, great. So here are the scenarios that I see. The Fed can go with a 50 basis point cut, which would be larger. It's not expected right now. You get a 17% chance market-wise of that happening. And there's basically a 0% chance of them going with 0. So I don't really see these happening. I do think that the Fed is not going to go with a 50 because they could go 50 and go hawkish, but again, 17% chance based on market expectations. Now, this is really killed by CPI, PPI over here. And because we're on the edge of employment layoffs and restaurant bankruptcies, I do think we'll get a dovish 25, so that way Powell can prop up that market. Now, that's actually interesting, because then when you think about that from sort of a trading point of view or an investing point of view, a dovish Fed could mean that you could see A, bond yields come down, and B, stocks go up. Now, stocks could get reset by Q3 earnings, and so that's the red flag with stocks. If Q3 earnings come out in October and they forecast weakness, well, that's not good. We're already seeing a lack of pricing power at companies, and so the question then is, when the lack of pricing power lasts for too long, at some point the layoffs will come. Now, you might say, oh, but Kevin, there are no signs of layoffs now. True. But that's by design, because imagine this. Imagine Amazon said, oh, we're doing layoffs because of weak demand. The stock would tank. Imagine Walmart's like, which I don't think Walmart would, but imagine they're like, we have to do layoffs because of weak demand. Tank. Okay, what's another one? Tesla, oh, we're going to do layoffs because of weak demand. Tank. Nobody wants, or a restaurant. A restaurant like Red Robin Gourmet Burgers is trading for like $3.50 or whatever it is right now. If they came out and said, yeah, we're going to have to lay off staff and close restaurants because demand is so poor, the stock would just go to $1.50 and half, and they'd go bankrupt. So in other words, if companies start laying people off now, they would be self-fulfilling their own stock's demise. So you don't lay off people when the stocks are going up. And the Fed's like, okay, well, if we can prop up stocks a little bit, maybe we don't end up getting the layoffs. But if the stocks fall and then everybody starts doing layoffs, well, then it's too late. Then you're already in a recession. Because as soon as stocks go down and people they get forced to do layoffs, then everybody does. Everybody jumps on the bandwagon. It's kind of very like herdish. And so I think that's one of the reasons we're seeing that labor hoarding right now. It's kind of a weird thing to think about, but I do think that actually bodes well for being bullish, a dovish Fed here. I think you get a bullish statement. I think it's going to lower yields and potentially prop the stock market up. Now, the stock market could falter on Q3 earnings, but I think those yields will move down after this Fed meeting. So that's my take, and I'm putting my money where my mouth is. I've got a trade that I think is well-positioned, again, for soft landing. It's well-positioned for the Fed next week, and it's well-positioned for recession. Now, keep in mind, if we get a recession, it won't do if we get a soft landing, it wouldn't do as well as if we had a negative shock. But that's okay. It's still a bullish thing. Like, it should still be great in a soft landing and be exceptional and amazing in a recession. That's why I sort of call it a larger hedge trade. But, yeah, anyway, that's my take. If you want to learn more about it, join the Stocks Aside group. Flash sale expires at 6 p.m. today. And, folks, we'll see you in the next video. Thanks so much for being here. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.